Hallo und herzlich willkommen. Hello and welcome to a Deutsche Goldmesse special edition Spezial an einem Donnerstagabend, Thursday night, special edition Deutsche Goldmesse German Gold Show. I'm excited to have everybody here. Thanks for attending. This is a special edition. As you all know, Rick Rule was supposed to present at our Deutsche Goldmesse about 2 weeks ago. And due to technical difficulties, we had to postpone. But I'm extremely grateful that he'll be joining us in a few seconds here on screen, on stage, and we'll be hearing from him for about 20 minutes in forms of presentation, but also we'll have lots of time for Q&A. So make sure to get your questions ready in the Q&A or chat function of this program of Zoom. I'm sure everybody is familiar with Zoom by now, and really appreciate you joining us. Also at Deutsche Goldmesse, we do have a bit of a Bildungsauftrag, a bit of an educational program and mindset here as well. So Rick is going to talk about how to also invest in junior mining companies, what things to look out for. So make sure to get your pencils ready, sharpen your pencil, maybe take some notes. And we won't have German translation today, unfortunately. But if you do have questions in German, just use the chat function. We have translators available that can help you in the chat. We just don't have simultaneous translation going right now. I think that's it from my housekeeping side, and it is my true pleasure to really to introduce Rick Rule. I've known him for a number of years now, and just I don't have to say that much. Like I can't even do justice to introduce him, but him coming on now for 60 minutes instead of 30 minutes at Deutsche Gold Show to make up for that little technical glitch, it probably says enough already. Not everybody would have done that, and that says a lot about his character. Rick has been investing since 1974, not just in resources, but he started out investing in 1974. It's tough to find somebody with more knowledge and acumen in the junior mining sector as well. I really appreciate his overall views on macroeconomics, but also the political situation worldwide. He calls himself an anarcho-capitalist. I find that really interesting as well. Libertarian to a degree, and his views are always insightful for the gold market. And I'm not just looking for confirmation bias today that gold is going higher. Rick and I chatted before. We chatted a couple of days ago in preparation for this, and I said everybody says gold is going higher. What are the reasons actually for gold going lower? Because if everybody says we're going higher, we might actually not. And Rick, I'd like to welcome you on screen now, and really thanks for joining us.
It looks, Kai, like I finally mastered the technology around Zoom. To begin with, to you personally and to your staff, thank you for putting on the show. And thank you for indulging my technical incompetence over the last 2 weeks. I apologize for my former failure. The lesson learned, I suspect, is don't trust someone my age with technology when you have an alternative.
Oh, Rick, you wouldn't believe what I've seen the last few months actually hosting our SF Live interviews. You are gold, trust me. So I really appreciate you joining us from your home in Anacortes now. So making the time on at 11 o'clock your time as well. So that's the busiest time of the day usually. So it's highly appreciated that you're taking 60 minutes out of your day to run us through your views. And as I said, I'm not just looking for confirmation bias. So I'm really excited to hear from you and put things into perspective. I'm going to turn my camera and microphone off, but I'm here, and we'll be ready in about 20-25 minutes to go over some Q&A.
Perhaps, Kai, while I have you, you could go ahead and queue up the Barron's Gold Mining Index chart, because I'll be referring to it. Perfect. I'll be referring to it really through the whole talk.
Okay, then I'll just leave that on. I'm just going to mute my microphone then.
Perfect. Kai has asked me to talk today in a sort of an educational sense about the lessons that I've learned in 45 years of investing and speculating, and how they shape the investing process and speculative process for me, and how they might be useful to others. And I will refer to this chart numerous times. I would, first of all, say, with regards to a disclaimer, that I'm not a technical analyst, so don't be looking for any technical commentary from me with regards to this chart. But I'll be referring to it as a visual aid to make some points quickly that would otherwise take me a long time to make verbally. I need to begin by saying I suspect that, as Kai described, because of my political and social belief, which is to say a belief in Austrian economics, and my sort of libertarian or anarcho-capitalist leanings, that I'm predisposed to the gold argument, and often nervous about other asset classes, maybe not for political reasons, but rather because I'm more familiar with extractive industries than other industries. And so the audience needs to take that bias into account. But anyway, enough of my disclaimers. I think the first thing that an investor or speculator in natural resources and precious metals needs to understand is that they are at once very, very cyclical and also very, very volatile. If you look at the almost logarithmic nature of the chart that's in front of you, you will get some sense of the cyclicality. If you look within the cycles, the bull cycles and the bear cycles, you will also see breathtaking volatility. Now, speculators and investors don't seem to mind cyclicality when it's working in their favor, nor volatility when they're working in its favor. But most investment processes, in fact, most learning processes are affirmational. So when the market moves against you, people tend to dislike it in the extreme. And I will talk later today about why that's a mistake. And in fact, both cyclicality and volatility work in your favor. Let's deal with cyclicality first. Natural resource businesses, including precious metals, are notoriously cyclical. These are capital intensive businesses. And so bull markets last longer than they otherwise would, and bear markets last longer than they otherwise would too, because of cyclicality and volatility. My slogan around that, and I'd like everybody to remember through the rest of the talk, this slogan, is that in natural resource investing, in fact, investing in any cyclical industry, you are either a contrarian or you are going to be a victim. This is easy to say, but tough to do. During the periods of time that you see on this chart, when the Barron's Gold Mining Index was cheap, it was because gold was extremely unpopular. And the reasons why someone might want to own gold, or by extension, gold stocks, were not readily apparent. The truth is that one must, as Warren Buffett has always said, have the courage to be brave when others are afraid, and the sense to be afraid when others are brave. And this chart, as well as many other charts that I could have put in front of you, describes very well the incredible cyclicality of the gold equities and the need to be contrarian or that you will be a victim. Notice the very, very, very sharp movements in price. One example would be 2007, 2008. The next would be 2009, 2011. What you will see there is that in Canadian rather than German parlance, one characteristic of a hockey stick graph is that the backside of the stick is just as steep as the front side, but much less fun for those who are long. So once again, you must be a contrarian or you are going to be a victim. It's odd the way that humans respond to data. We believe ourselves to be impartial fact seekers, taking information from all facets of life and analyzing that information rationally and making intelligent decisions, which is not true. We seek information that supports our existing biases and prejudices. We don't seek information from all sources to make rational responses. We seek information that makes us comfortable with what we already believe, which is a problem. We also suffer, as Ludwig von Mises points out, recency bias, which is to say our experiences in the immediate past assume larger importance for us than historical norms, which may be more appropriate. And they cause us to ignore reversion to mean in favor of much more recent stimulus. What that means is that, as an example, when the gold price goes from $1,100 to $1,900, which is to say that a nice move has already taken place, the market seems more attractive than it was back at $1,100 when it was in fact cheaper. You will see the peril of that belief simply by examining the chart. Without beating this to death, the first thing to know about investing in cyclical businesses is that you are either going to be a contrarian or you will almost certainly become a victim. The second, and this has been very hard for me to learn, is the desirability of probabilities over possibilities. Everyone, of course, wants certainty, and looking in the future, there's no such thing as certainty, or at least certainty occurs very seldom. And so the best that we can ask for is probability. In other words, try and determine to the best of your ability what is the most likely outcome as a consequence of a variety of factors. Now, most people listening to this broadcast, I assume, regard themselves as conservative investors when in fact they are wild speculators. So understand, I would say, the principal difference between investment and speculation, which is to say that investors look for reasonable rates of return on capital in circumstances where the outcome is probable, while speculators look for much larger returns on capital as a consequence of taking risks around what are possibilities rather than probabilities. Returning to this chart for a while, if you examine the history of this chart, if you examine the set of circumstances that occurred at market bottoms and at market tops, you learn a lot about the difference between probability and possibility. During a period of time, as an example, when confidence is very high, demand for gold as an insurance asset class is very low. That very complacency sets the stage for returns to mean. These are probabilistic events. The probability versus possibility scenario is much more dramatic, however, in materials other than precious metals, which is to say industrial commodities, base metals, and the like. I realize this is a gold conference, but indulge me because I know that most of you are interested in all types of extractive industries and certainly interested in making money, irrespective of the asset class. In the rest of natural resources, what's interesting to note is that industries that are in liquidation, where the commodity in question is necessary for our standard of living, always do well. When you have a commodity, let's say oil and gas, Ms. Thornburg notwithstanding, that is out of favor, and where the industry's average cost of production exceeds the selling price of the commodity, one of two things will happen. Either the price will go up or the commodity will become unavailable. These are probabilities. In other words, think what you like about oil and gas, think what you like about carbon. The fact is that the utility of oil and gas are very high. If it takes, as the International Energy Agency suggests, $60 to make a barrel of oil, including social costs and cost of capital, and the industry sells it for 40, what the industry does is lose $20 a barrel 90 million times a day. That means that either the oil price goes up or 5 years from now, your car doesn't start. This is the difference between probability and possibility. And I want everybody to take note. I'm not saying don't speculate. Of course, all the money that I invest today, I made by speculation. But I have always, or at least for the last 40 of the 45 years I've been involved in the game, understood the probabilistic nature of both investing and speculating. And we're going to return to probabilities later today when talking about the reasons why I'm long-term bullish about the precious metals markets. The second part of probability versus possibility is learning where possible to ask yourself a question, where the answer begins with when, not if. As an example, many people, because of their time preference, don't like companies that have delivered feasibility studies and that are in the financing and construction part of mines. They describe this as a boring period. The interesting thing about this is that the boring period has a finite time, and the probability of delivering success is very high. It's interesting that people's time preference exceeds, in many cases, their probability preference, which is to say, people would rather take an if chance, say a drill hole where they get a yes or no in 90 days, then take a when chance, which is to say they are unwilling to be bored for 2 years or 2.5 years. They would prefer to be terrified in 90 days. And identifying your time preference and learning to favor questions where the answer begins with when rather than if, I think is a critical part of becoming a successful investor and a successful speculator. All of this is going to seem self-evident as I say it, but of course most people don't employ it. So refreshing one's minds about the fundamentals of speculation is still a necessary thing. Value versus price. Speculators study price slavishly. It's easy to understand information. It's easy to grasp information. And it seems to be information that talks about what part of your portfolio is spendable by you. But price information is only useful if you have some estimation of the value. Money is made, other than by luck, on the delta between price and value, which is to say, if something is selling for less than it's worth, or something that you think is going to be worth more, then it's an attractive proposition. But most people don't spend very much time ascertaining value while they focus slavishly on price. This is a very, very, very common fallacy. Understanding, as I say, that money is made on the delta between price and value, a story that has lagged, a narrative that hasn't performed in the market, where the value has been established, ends up being, in almost every case, a better speculation for a better speculator than very well promoted, very well hyped names where the price action gives people more confidence. But the relationship between price and value has, from a speculator's point of view, deteriorated substantially. The fourth thing I want to talk about very briefly before I get on to the bull market in gold is Pareto's law. For those of you who aren't familiar with Pareto's law, Pareto was an Italian social scientist who codified in social science purposes what in English we call the 80-20 rule, that piece of sociology which suggests that 20% of a population generates 80% of the utility. It turns out across very many social science databases that this law is roughly true. And of course, it's a bell-shaped curve, which suggests that 20% of the population in any given task generates 80% of the utility, while a different 20% of the population generates, if you will, 80% of the disutility, or in colloquial English, the aggravation. What's necessary for you to understand as a speculator is that you can take both lips of the bell-shaped curve and run them through the same performance dispersal curve. And you'll find that those curves conformably align for a second and probably third standard deviation. That's a fancy way of saying that 20% of the 20% generate 80% of the 80% of utility, or 4% of the population base generates 65% more or less of the utility in any given task. And in my own experience, this correlates at least one more time, which is a suggestion that 1% of the population in any task generates about 40% of the positive utility. What does this have to do with mining? Well, simple. 1% of the management teams that I have been involved with over 45 years have generated more than 40% of the returns that I had enjoyed. In speculative activities, the single best thing that you can do is attach yourself to the best of the best. Takeaway from this, in 45 years of speculating, most of it successful, some of it wildly successful. Had I concentrated my efforts around the 10 teams who I found to be most successful in the period of age 25 to 35, I would have worked half as hard and made twice as much money. Remember Pareto's law. Now, let's talk about probabilities and possibilities looking forward in the gold market. Let's talk about probabilities first. Why is gold popular and why do I think it's going to move higher? In my experience, the gold price has responded to many factors around fear. Fear of war, fear of confiscation. But the most important fear has been fear of the degradation of purchasing power of savings denominated particularly in fiat currencies, and particularly as an American in the world's reserve currency, the US dollar. I believe these fears of purchasing power in conventional savings products denominated in euros and pounds and in the US dollar is a real fear for three reasons. The first is quantitative easing taking place in every major market, and in fact, most of the frontier markets too. Quantitative easing is simply creating more currency units that are created out of bounds of the growth of the underlying economy. If Kai was to engage in this activity, if he was to print Kais, he would be arrested either for fraud or for counterfeiting. Were Kai, however, a member of parliament, his policy would be wildly popular and he would be elected. I don't see any end to quantitative easing, which is to say, I don't see any end to central bank counterfeiting, which by its nature debases the currency and debases the purchasing power of savings denominated in that currency. The second is, of course, debt and deficits, and not just a US problem, a universal problem. Debt and deficits are really a function of the world living beyond its means. We finance our current lifestyle on the backs of our children and our grandchildren. And this by its nature debases the currency and debases our sort of sense of savings. Savings, of course, is what future prosperity is built on. And again, I don't see any end in the immediate future, the 3 to 5 year time frame, in debt and deficits. I would love to be wrong, but what I see is that both debt and deficits are extremely popular. The most important that I see is negative interest rates. Interest rates are, of course, the compensation that savers get for foregoing consumption, and also a recognition both of the risk inherent in the debtor that they lend the money to and the risk associated with the time value of money. I was taught, and I believe it still to be true, that the world's benchmark security is the US 10-year Treasury, the deepest and most liquid savings instrument in the world. The US 10-year Treasury at present pays about 70 basis points in a currency that the Congressional Budget Office suggests is falling by 1.6% a year. In other words, the US government is promising to cost you almost 1% a year on your savings for 10 years. Jim Grant calls this return-free risk. And I would argue with you that gold's most important competitor in the investment and savings market worldwide is, quote, return-free risk, not a tough fight. Now, if all that is true, why have we experienced very recently a malaise in gold prices and gold equity prices? That's very simple to look at if you look at the chart. Observing the chart, you will see a couple phenomena. One, recoveries from oversold bottoms, which occur in both bull and bear markets. And what I would describe as two important cyclical bull markets. Within both the recoveries from oversold bottoms and the bull markets, you will see extraordinary cyclical advances and declines. The truth is that the gold equities in particular can increase over the short term or decrease over the short term by 10 or 15% with the ease and frequency that you and I breathe. And I believe myself that we are engaged in a cyclical decline in a secular bull market. What would change my mind? Easy. An end to quantitative easing, aggregate debts across the Eurozone and in the United States that were less than 1% of GDP, or at least less than the growth rates of the underlying economy, and a 200 to 250 basis point real yield in the US 10-year Treasury. Do I see any of those on the offing? No. So from my own belief, a gold bull market is still intact, and as a consequence of that, a gold equities market is intact too. That doesn't mean, as I say, when you look at this graph, that the gold equities indexes will be stair steps to heaven, or if they are stair steps to heaven, you will need to understand that on the way higher, in fact, you will expect some lower steps as well. I would draw your attention as a speculator in particular to one phenomenon that I've noticed in my own speculations. I've been fortunate enough in my life to participate in a lot of success in the mining business that saw companies in my portfolio escalate by 1,000% or more, which is lovely. Two comments on that I think are instructive before I ask questions. The first is that these tenfold increases generally took from 4 to 6 years to occur. So in terms of time preference, you need to have a very low time preference. You have to be very patient to enjoy tenfold returns. But a more important lesson is that every single 10-bagger in my portfolio, I believe, that I've enjoyed over 45 years, has fallen by 50% or more during the period of time that I've held it, which is to say that I had to have enough courage of my convictions, enough courage in the narrative, enough courage in the assets, enough courage in the people, that I was willing to endure a 50% decline once or more during the course of my holding period in order to enjoy 1,000% gain. So one more time, let's go through these. You got to be a contrarian or you're going to be a victim. You need to learn to prefer probabilities over possibilities. In particular, you need to prefer questions where the answer begins with when rather than if. You need to focus on value before you worry too much about price. And you need to understand, particularly in sub-billion-dollar market caps, that people are everything. Pareto's law means literally that 4% of the population base generates 65% of the utility, and 1% of the population base generates 40% of the utility. Most of the population base in mining company managements are either unwitting or unscrupulous, pardon me, which means that you ignore them. Finally, I suspect that if you are willing to endure cyclicality, that the wind is in gold sales and hence the wind is in gold equity sales. Kai, with that, we'll return to what the audience really cares about because we'll answer their questions.
Fantastic, Rick. That was super informative. Really, really appreciate you running us through that. And you left so many nuggets. I took down so many notes, and I'm sure our listeners did as well. We have a really good turnout as well, so I really appreciate everybody dialing in. I was told I speak too fast, so I'm trying to slow down just a little bit. You're so much better at this than me. We didn't get a single complaint about you speaking too fast, so it's just lots to dig into. And like, I'm going to start us off with a couple questions. But ich bitte Sie alle, ihr Fragen zu stellen im Chatfenster, gerne auf Deutsch. Wir können das gerne übersetzen. Und we could translate any questions you have. I see we've got a very international audience today. I saw Bangkok, Belgium, Netherlands, Utah, all parts of Germany. So I'm quite excited to see that. And Rick, gold market equity, or the gold equities market is still intact. And let's put that into perspective. You just said that, and the gold price is quite volatile, and I've said that before. It feels more like a realistic reflection of what the actual market should be like. How should investors play this right now? And I wouldn't say play if you were I use the word investor, not speculator, based on what you've been saying. Investor, position themselves and be invested right now.
I think there are several answers to that. No one size fits all. And it's really a function, first of all, of how much work the investor or speculator is willing to put in. Of course, this is a tempting market to go after alpha in because the search for 10 baggers is always fun. But the search for 10 baggers is only appropriate for those who can afford to lose half their money and who are willing to work. As you know, Kai, I rank thousands of portfolios for individual investors. And one of the things I've noticed is very long laundry lists of stocks, people with 50 or 60 stocks or more. I would suggest as a start that speculators limit the number of names in their portfolio to the number of hours per month that they're willing to spend on each stock. And I don't mean listening to videos necessarily, but rather annual reports, property reports, analyst reports, proxies, and the like. For most investors, in truth, Kai, their portfolios are too small to spend that much time on. And those investors need to pay attention to the fact that bull markets in gold are generally longer in duration than people know, 10 years, and greater in dimension than people know too, 500, 600% top to bottom in terms of dimension. For most investors, buying the 5 or 6 finest gold companies in the world and actually being willing to underperform the index a little bit, but de-risking it in terms of company performance is the best possible strategy. Now, people who are taking the time to listen to you are probably more sophisticated. So there's a third option. For value-oriented investors, looking at the various subsets of the industry and trying to figure out where the value is probably enables you to outperform the index with less risk than you would assume in the index. As an example, I believe that the junior sector is still well ahead of itself in terms of price. And I believe that the best of the best are probably fully priced. But the middle part of the sector, the single asset companies, some of the, if you will, agglomerators, on a free cash flow basis are as cheap as they ever get. Cash flow relative to the gold price. I believe they're very, very cheap. And I believe they either get taken up in price or they get taken over, both of which are great outcomes.
No, exactly. And that's where you get an extra X on top of your original value X that you were looking for anyway. Again, in your answer, you actually dropped quite a few more nuggets again as well. It starts with finest producers. How do you even qualify that? Is Barrick the finest producer or Newmont the finest producer because they're the biggest? How do you define finest? Is it more ESG principles? Is it production size or production cost?
I would define it at least three ways. The first is price to value. I try and construct a production model going out 10 or 12 years. And I don't make commodity price forecasts. I use the forward strip in the commodities market to do that. So I try to establish net present value. And then I risk net present value by margin. I like high margin businesses. So I tend to err on the side of the Franco-Nevadas, the Wheatons, the Barricks, the companies that enjoy very, very, very large operating margins. They have less upside as the gold price increases, but the upside, in my experience, takes care of itself. I'm interested in guarding against downside. The third thing I do, if I'm able, is I find management teams in companies with long duration where I can build my own opinion of their ability to reinvest free cash at high rates of return. It's the recycle ratio, which is the ability to invest margin to generate new margin. That is the real test of a management team over time. So I look at the management team's track record where that's available. I look at the margin, and I look at a reasonable model of net present value. I find too, Kai, in my declining years, that I have a fondness for world-class deposits, great big deposits. In my experience, every deposit gives you a surprise, and big deposits give you pleasant surprises, and small deposits give you negative surprises. And at age 67, with my limited time left on earth, I prefer positive surprises.
Yeah, you got to swing. You don't have to swing anymore. You just pick the big ones. That's a good point. And again, just like I could ask you so many questions. You mentioned Franco-Nevada. Maybe allow me one before we get to all the questions here. And the last one is like, how do you really rank royalty companies in that regard? And how big of a portfolio or of your portfolio should be allocated to maybe royalty companies of the overall precious metals mix?
Conventional analysts, I think the royalty companies are way overvalued, which I disagree with. I think that you pay more for an 80% margin business than you do for 12% margin business. Life has taught me that margin is safety. The second is that a royalty business is easier to model, as is a streaming business, because they don't have sustaining capital investments and they don't have new project investments. And all of the upside that they get from those big legacy deposits is built in. So I think that the royalty businesses are appropriately priced. It is very true that if the gold price triples from here, that the royalty companies will underperform the index. I'm okay with that. They underperform the index by de-risking the index. You can take away part of an old man's upside if you take away all of his downside. I like that trade.
That makes a lot of sense. No, and that's exactly the answer I was looking for. Because yes, gold producers will probably perform way better than the royalty companies, but margin is safety. I like that statement. So we have a lot of questions, and please keep them coming. So I'm just trying to see. Here's one. How can I recognize a capable management team which is able to create shareholder value in the junior mining sector? And that's an interesting one. And I'm going to extend that question. And you said go with the proven team. So there's like I'm actually half answering it. But are you taking shots with younger kids? You mentioned the 25 to 35-year-olds that you could have made a lot of money with. And how do you find those?
So let's unpack those questions. You try and find a CEO in particular, the chief ego in the company, who has been successful in the past. Let someone establish their success with their own relatives' money, not with my money. I'm willing to pass on the first-time person with a lot of promise. Maybe I might try it a little bit with my own money, but never with other people's money. In other words, I never risk my reputation on those circumstances. It's important, too, that the success be reasonably closely identified with the task at hand. And let me explain that. If someone has been a success in mining, but his or her success came from operating a gold mine in Archean 2 billion year old terrain in French-speaking Quebec, but the task at hand is exploring for copper gold porphyries in 15 million year old accreted terrain in Spanish-speaking Peru, you'll notice that the success doesn't have very much bearing on the task at hand. So in addition to being successful, and there are some exceptions to this, there are some polymaths in the business, but the success needs to be focused on the task at hand. And similarly, the construction of the management team should be with a view to the task at hand, as should the construction of the board of directors. If I can't understand the construction of the human resource package with regard to the task at hand, I have no interest in speculating. The truth is that you find people in the world who have been serially successful. I'm thinking about, as an example, Ross Beatty or Bob Quartermain or the Lundin family or Robert Friedland. And as I say, had I concentrated my efforts over the last 40 years on the people who made me money in my 20s, I would be further ahead. Now, the challenge is to find younger people that have legs that won't literally die on us in this cycle. People of your age in their 30s, 40s, or early 50s who have already been serially successful, but hopefully who are less well known in the market so that they can't attract the premiums that a Ross Beatty or a Robert Friedland would attract. And I think that's a very worthwhile enterprise.
Interesting. Oh, that's a really good answer, because oftentimes it's just look at track record, young teams, but you actually give some solid advice also in terms of the board of directors, how that's constructed. That is quite helpful, actually. You don't hear that too often. You often get the canned standard answers in other interviews. So I really appreciate that. In what market segments or stocks do you currently have strong knowledge in arbitrage, and where do you perceive little or no to little risk, whereas the market does price risk in? So, in other words, where do you see the most opportunity?
Well, that would be outside the gold market. I see lots of upside opportunity in oil and gas. I believe when your audience addresses the oil and gas business, they just need to ask themselves a simple question. 5 or 6 years from now, when they go to the garage and turn the key to the right, will the car start? And if they believe the car starts, unless they're rich enough to and woke enough to own a Tesla, they believe in higher oil prices. So I see incredible opportunity there. You'll have to endure, of course, the hatred of your brothers and sisters, but that's okay. They're going to hate you anyway. Another one where I see extraordinary upside is in the uranium business. I don't necessarily see it quickly, but the truth is that the world needs more of all kinds of energy. Uranium, notwithstanding its lack of popularity in your home market, that doesn't matter much. So I see that. You always see opportunity in places where people are either bored or afraid. And so I look from sector to sector for boredom and fear.
Interesting. Yeah, it's like oil and gas is a really interesting one, because when somebody once told me, like, tanks will always need diesel. So you will always need oil and gas, right? Because you can't have an EV tank because that's too easy to shut down.
My
So
suspicion is that we'll see peak oil demand in sort of 2035. On a net present value basis, that kind of doesn't matter much. And you won't see supply equaling peak oil demand at any price resembling US 40.
no, so we had Dr. Thomas Gutschlag here on the program during Deutsche Goldmesse. He's the CEO of a Germany-based but US operating oil and gas company, and he said that we're back to pre-COVID level oil consumption, which was really interesting for me because I wasn't looking at it and I wasn't aware of it. But the oil price really hasn't reacted, so it's still pricing in the current pandemic, in my opinion. So that's quite interesting. We're going back and forth a little bit, and one topic that's come up in questions quite often is really the cryptocurrency aspect. Bitcoin has been running way more so than gold has, and you hinted at Kai printing his currency or Kai printing money in your speech. But what if I were to issue a cryptocurrency? And how do you see Bitcoin and gold moving forward?
I see them as segregated asset classes, alternative asset classes to be sure. The advantages of cryptocurrencies are the frictionless mediums of exchange and the fact that they're uncontrolled. I don't have to trust anybody. I get to trust the whole network. And that's important. Anonymity, too. The difficulty, I guess the difficulties I have with Bitcoin, one is that it seems to be more popular at $14,000 or $15,000 than it was at $7,000, which is the classic example of a bubble disconnected to utility. In other words, people like it more after the price has doubled and its utility relative to price is halved. That's an amazing fallacy. But going back to the subject itself, anonymity is being attacked in Bitcoin and the other cryptos as the crypto promoters want to spread adoption of it. Many of the adherents to Bitcoin and other things want to see it regulated and in fact controlled. That takes away one of its key advantages, which is the fact that you don't have to trust anybody. You trust the system. And anonymity. The second is its very volatility. The volatility mitigates against its utility as a medium of exchange. Because the volatility means that you never in the near term know what you paid for something, or as a merchant, you never know what you receive for it because of the volatility of the medium of exchange. A medium of exchange whose central utility is called into question is one that's difficult. The third problem I have with Bitcoin, and I sort of understand the answer to this, is that I look for a medium of exchange that isn't a promise to pay, but is rather payment in and of itself. And I look for an asset class that has attributes of being a store of value rather than merely being a unit of exchange. I don't know why gold does that. What I do know is that looking back 6,000 years or 7,000 years, reverence for gold and recognition of gold's utility occurred in civilizations that we have no record of having contact with each other in South Asia, East Asia, Eurasia, Africa, Mesoamerica. Gold has been valued for its beauty, for its malleability, for its consistency for millennia. And as a consequence, it isn't merely a medium of exchange, it's a store of value. It isn't a promise to pay, it is payment itself. And Bitcoin needs to establish that. I understand that part of the value, part of the utility is the network itself. And it arguably becomes more a store of value as its utilization and the frictionless nature of transactions increases. In other words, where the stock of currency and the utilization of currency begins to exceed by a substantial amount the supply of the currency available to increase. I get that part, but it isn't there yet for me. I'm intrigued by Bitcoin, and as an anarcho-capitalist, I pray for its success. And I would note that I'm a consumer of currencies. So the idea that there were 40 or 50 currencies that were competing to offer utility to me as a consumer is a very good thing for me.
Yeah, no, it makes sense from an anarcho-capitalist point. You get the anonymity, and that's why probably cash will survive for a little bit longer. But also, like and I'm taking your words. You said you're 67, and one comment I heard about Bitcoin is that the older generation cannot adapt, is not able to use it on their phone. And you said you're what would you call it, an electric? What did you call yourself when it comes to technology?
Inadvertent Luddite.
That's the word, exactly.
In fact, I can make crypto work on my phone, but that took the assistance of a lot of young, smart people.
Right. So that's a big Henderson. That's a big hurdle, I think, for many still as well, is the technological hurdle, make it work. And then I think it was Peter Schiff who actually lost his password and lost quite a few Bitcoin because he lost his password to his wallet. So there are some certain hurdles to Bitcoin as well. So um, let's move on with the questions. And we're getting a lot of questions, and I really appreciate the activity here. And there is one. If I'm new to the mining sector and therefore have little experience, can I make mistakes when I invest in stocks where Eric Sprott is also invested? So, and one thing, maybe I add to that. And in Germany, I've noticed that Sprott is still Sprott. It's not the Sprott Inc. US, where you're part of, but it's also Sprott Asset Management, Sprott Lending, and of course, Eric Sprott himself. So maybe start with a quick history lesson with the name Sprott.
Sprott Inc. was founded by Eric Sprott, who is probably the iconic speculator in precious metals and to a lesser degree, natural resources. When we became a public company, our practices became constraining for Eric. Eric has an incredible degree of certainty and an amazing capacity, both financial and psychological, to accept loss, which is how he has gained so much. The consequence of that is that although he is still a very large shareholder of Sprott and very supportive of all of our efforts, he is no longer an employee of Sprott. And so when you see that Eric Sprott has made an investment, we may or may not have participated in it with him. We may or may not have drawn it to his attention. We're still very, very, very close, but we are no longer synonymous. Eric is one of the best all-around speculators I've ever met. And he is that way for three reasons. The first is certainty. People forget that Eric's a chartered accountant, and he studies the numbers, both the macro and the micro numbers, very, very, very hard. And he is very willing to be early, less willing to be wrong. But he is willing to be wrong. Eric understands that repeated 50% failures are the price of 1,000% or 1,500% successes. Eric, I don't know his net worth, but I know it's large, has the financial staying power to accept those risks, temporary or permanent. And I remember Eric telling me in 2015, when he really began to go all in on the gold trade, I said, these are pretty aggressive bets, Eric. And he said, well, with the amount of money that I am going to put in these speculations, if I lost it all, it wouldn't change my decision as to what to have for breakfast. But if the outcome is what I expect it to be, the transition will be dramatic. And I think that Eric has the willingness and the ability to do the work at the same time that he has the psychological and financial staying power to stay the trade. Most people don't.
That's true. And exactly, like you can't, and I watched an interview earlier today where you gave that advice, and always keep 2 months of cash or cash flow on hold. Don't overextend and only invest what you can risk to lose, right? Those are the main principles. And if you're a billionaire, even losing $950 million, I think you'll still be fine. Right.
Correct.
So that's how I interpret it. And so we're jumping back and forth a bit, but I really appreciate those questions. So QE in the last times exceeded with greatness the emissions of 2008 and 2009, and there's a flood of dollars in the market. Nevertheless, the high of gold is very similar to what it was 10 years ago. And that doesn't include inflation, obviously. Like, how do you explain that we haven't seen a higher high so far?
I think an examination of past bull markets provides an easy answer to that. I remember in my first gold bull market, which was 1970 to 1981, in the middle of that bull market, you had a bit of an interest rate rise, which means that you had an increase in the US dollar. The gold price between 1970 and 1975 had gone from $35 an ounce to $200 an ounce. Six-fold move, nice move. That move had caused it to gain a lot of adherence. In 1975, the price fell from $200 US dollars to $100 an ounce. A cyclical decline in a secular bull market. That decline shook a lot of people out. So the truth is that people don't understand bull markets, either for their duration or for their dimension. If you examine the gold bull market, the later bull market, 2000 to 2002, if you will, the fix was in, but the response on the market was slow. These things build, they quote, climb a wall of worry. And that's the phase that we're in right now. People need to be concerned about the gold bull market if we see an end to the reasons that are causing it, which is to say quantitative easing, debt and deficits, negative interest rates. And by the way, one final thing, which I should point out, gold is very, very, very under-owned. Most investors, despite the fact that it's only 4 letters in English, can't spell gold. It is estimated that the market share of precious metals and precious metals related assets in the US market is less than 0.5%. The 3-decade mean was between 1.5% and 2%. So gold doesn't have to win the war against the US dollar. It just needs to lose less badly. If it reverts to mean, demand in the US market triples or quadruples. And my suspicion is that's what happens. But investors want it to happen now. If they buy into the narrative, they want to confuse the words imminent with inevitable. And that's a mistake.
Good point there as well. And going on there, and I wish we could talk about this forever. Is like there's so many answers and so many variables to it. But I really want to get to the questions we've been sent in as well via info@deutschegoldmesse.com. And one of them was, what are your thoughts on Great Bear? Is this a takeover candidate, and for what price? What are your thoughts on this company? Like, and I don't want a company-specific answer, but I'm more fishing for takeover candidates. Who do you see will be benefiting from the high gold price right now?
I can't make recommendations with regards to Great Bear. I can disclose that Sprott has been, both Eric and our company have been real supporters of Great Bear. There has been underinvestment industry-wide in exploration for at least 10 years. I would argue underinvestment and misinvestment, in fact, for 30 years. And the consequence of that is that high-quality discoveries are very rare, and development opportunities are very rare and hence very valuable, particularly in jurisdictions that are perceived to be friendly to and beneficial to mining, and particularly in areas where there's great infrastructure. Great Bear potentially ticks all those boxes to the extent that they can prove up the target that they have demonstrated might exist. I suspect that it would be an extraordinarily attractive takeover target. I don't want to comment about the relationship between price and value based on data today, because that could be constrained as investment advice. But I think that although exploration is in some senses out of favor, what you will see in those rare instances in the next 2 or 3 years where exploration success turns up a good tier 2 or a tier 1 deposit, that the multiples that are paid for that deposit are indeed eye-popping. What I can say about Great Bear that is interesting is that it's at that stage in exploration where the drilling has at least appears to become predictive. When people are using the drill bit to explore, that's one thing. But where they're putting forward exploration theses that are demonstrated to be true time and time again with the ore body, with the drilling, what it means is that the team appears to understand the genesis and the structure of the deposit well enough that they get to add ounces very quickly. And the recent news out of Great Bear suggests, rather than perhaps than demonstrates, that the understanding of the nature of the ore body has come to be good enough that the exploration is predictive, which is a very good sign.
And it seems like in the question where I took it from actually included a resource number that seemed a bit out of thin air, but because the company hasn't published one, so that person must have done its own resource calculation. And I think Great Bear has a data room open as well, so everybody can go in and do their own math and calculations, I think. So let's leave it at that. We've been getting quite a few questions also about where do you see the biggest opportunity in the gold space? And maybe I'll just summarize what you said before. It's maybe not the large caps, but more the mid cap companies that haven't seen the value appreciation that you were looking for. So can you hone down on that a bit?
Yeah, I think there's 3 answers. I think that for most investors, the best of the best. Don't worry about trying to beat the market. De-risk the market. Most people won't do that because it's boring. The middle part of the market, the single asset producers, which are rightly perceived to be riskier than the multi-asset producers, trade at lower multiples. And that valuation discrepancy can be altered with a takeover. They become part of a multi-asset producer, and that's gone. I mean, that's a no-brainer right now. There are other companies that are beginning to generate really substantial free cash flow. And that free cash flow, relative to their enterprise value, is at prices relative to the gold price that are at historic lows. one of two things happen. Either the value-oriented investors come down from the best of the best to the best of the rest, or they get taken over. So there's a lot of arbitrage in the middle of the market that I think is attractive. And in truth, there is opportunity that will emerge in the junior markets too, opportunities for stock selection. I have long held that if there are 2,000 juniors worldwide, there may be 300 that are worth speculating in, and 1,700 are worthless. We were in a period over the summer where the good, the bad, and the ugly, the wheat and the chaff, all went up and all got financed. Now they're all going down together. The truth is that the best of the juniors and the flotsam and jetsam, the rot, are declining with equal rapidity. And if people get, as I suspect, disgusted with the juniors, I think that you're going to have the opportunity to work harder than your peers and really outperform people. But that presumes, of course, that you're willing to do the work.
And that's a big part. I got two more questions for you, and we're running almost out of time. We got 5 minutes left, and I really appreciate your patience with us here. How does Sprott Inc. actually select their stocks? And we maybe should have invited also Neil Edshead on here to ask that. And what is the most important thing? What is less important? We talked about management, so maybe we'll leave that one out. But also capital structures came up, geology. What else are you looking for in your selection process?
Understand that we have 8 principal portfolio managers. And so methodologies and our products are necessarily different. Neil and I have invested together, not as partners, but certainly as colleagues for the better part of 20 years. We do things very differently. We each have expertise to lend to the other, but there is no one size fits all in Sprott. Much of what we do on behalf of investors is in exchange traded funds, where the approach is sort of mechanistic. Neil is on the other end of the spectrum. His product, Drill Driven Alpha, really invests in his ability to differentiate successful exploration efforts from others. My methodology is more net present value or probabilistically oriented. So the truth is there's no one size fits all answer. Remember that for better or for worse, I think better, of course, we manage about $17 billion, and there isn't any one size fits all answer in an asset base that size.
No, exactly. Fantastic. That's a perfect way to answer that as well. And we have actually one more question I can squeeze in before the last one. And when you say you have confidence in your convictions and having your share price drop 50% for 1,000% gain, when do you make the decision that it's actually a dud or it's going to be a winner? Like at what point?
You need to re-examine your premise. You make a decision based on fact, not price and emotion. Warren Buffett has famously said that you shouldn't buy a stock if you don't know it well enough that you wouldn't be delighted to see it fall 30% in price the month after you bought it, so that you could buy more using the same intellectual capital. Now, sadly, Kai, I've been tested by that thesis dozens of times, but I found it broadly to be true. The best winner of my career was Paladin, which I bought at 10 cents and saw it fall to a penny. Now, if you have a 90% loss in place, you don't have a hold. You either have a buy or you have a sell. Mercifully, I was able to dispassionately look at the various factors around the investment, and I had the courage to buy substantially more stock at a penny than I had at $1. And I was rewarded by seeing that stock go from a penny to $10 in the next 6 years. So it isn't the price action that scares me out of something or attracts me to something. It's the relationship of price to value. Sudden moves up and sudden moves down must necessarily cause you to re-examine the facts and revisit your premise.
Fantastic. And like I keep wondering when stocks go down like that, like maybe my thesis was wrong instead of you revaluing the premise, right? Like maybe my premise was wrong.
Very good question. Very good question.
Yeah, fantastic. Rick, the very last question, and I've noticed that our investors or attendees here have quite a need for information and want to learn more, which is awesome because that's exactly what I want to get out of this as well, the educational factor. And a question that's come up a couple times: what books or what kind of platforms or services do you recommend reading to get up to speed if you're a novice or just want to be more educated in the mining space?
First of all, access me. I enjoy it, and I'll give your listeners an incentive to do it.
I
Any
was
of
going
your,
to say that. I was going to wrap up with that. So
you want me to
you're
save
taking
that?
it away.
You want me to save that or do it now?
No, go ahead. Like, it's perfect timing.
Any of your listeners who want to access my own knowledge, I'll give them an incentive. If you go to a website, sprotusa.com/rankings, and enter your natural resource equities. Please, no pot stocks, no banks. I will rank those 1 to 10, 1 being best, 10 being worst, and I will comment on individual issues where I think my comments might have some value. In addition, I'll forward two charts. One, the Barron's Gold Mining Index chart that you use. Another is a 100-year commodity chart. And I found, Kai, that giving people education that's centered around their own portfolio rather than more esoteric concepts is the best possible way that I can teach. If you give someone a 7 on a much less than favorable grade on something that they thought was the greatest things in sliced bread, while it isn't a very affirmative way to sell, it is a wonderful way to use the comments to educate people. I've done over 19,000 of these so far, and it's been wonderful for me, and given the feedback that I've gotten from thousands of investors, useful for them too. In terms of books, Kai, I have several I recommend. Economics in One Lesson by Hazlitt, if you want to know the way the economy works, as opposed to the way that you were taught in university that works. A great book, easy to read, spot on. For investing, The Intelligent Investor by Ben Graham. Relative to the effort required to read it, simply the best investment book ever written, partially because it's easy to read. If you found that book enjoyable, the best investment book ever written, from my point of view, is The Intelligent Investor by also Ben Graham, the guy who, among other things, taught Warren Buffett. This is not easy to read, but if you employ the lessons in The Intelligent Investor, you will become rich. Simple declarative statement. You can't read it, just read it, you have to do it. Finally, the granddaddy of all books, with regards to my own development as an investor, was Human Action by Ludwig von Mises. Also a wonderful book as a cure for insomnia. But
I just ordered it. It's still plastic wrapped on my windowsill. I ordered it a week ago, and it's a four volumes. I think it's like 4 separate books. I think so. I've ordered the whole edition.
It really does talk to human action. It talks about why we do what we do, both as individuals and as groups, and how to guard yourself against your worst enemy, which is to say yourself.
Fantastic. Rick, I really, really appreciate it. We're out of time. Thanks so much, and giving us an extra 30 minutes. It shows a lot of character, and I really appreciate that. You wouldn't believe. Everybody else, thank you so much. Vielen Dank, dass Sie sich eingewählt haben, dass Sie heute teilgenommen haben. Schreiben Sie uns auch eine kurze E-Mail. Was halten Sie denn von dem 20 Uhr Start von solchen Webinaren? Wir haben das extra gemacht, dass Sie sich nach der Arbeit einwählen können. I just asked, like, what do you think of the later start? Because it's 8 o'clock already. It's almost 9 o'clock now in Germany. It's 9 o'clock in Germany now, PM. So just asking what the general feedback is on that as well. Rick, thank you so much again. sprotusa.com/rankings. That's where they can get your information. I really appreciate you supporting us. You were a sponsor of the event as well, Deutsche Goldmesse. So appreciate the support. Thanks for coming on. And I hope to visit you and see you again soon.
A pleasure. And thank you for accommodating my technical failures earlier.
Easy peasy. Awesome. Thank you so much.